Good evening, friends. I, CA Preeti Oza, a co-convener of Finance, Corporate and Allied Laws Committee Study Circle of BCAS, welcome you all to the today's session on how to read and analyze annual report. Companies are mandated to make at least prescribed disclosures. An annual report is considered to be the financial barometer of the company's performance during the relevant financial year. Annual report comprises of various components such as balance sheet, profit and loss account, cash flow statement, notes, auditor's report on financial statement and international IFC, board's report, and so on and so forth. It's high time that we move from financial literacy to financial intelligence. That is not only to read, but also to understand and analyze such information, to attempt to read between the lines if possible, to identify the secret reserves of fictitious assets or hidden or hanging liabilities or endangered going concern, so on and so forth. To unlock the secrets of financial analysis, today we have with us none other than CA Pankaj Tiwari, who is a known face in this fraternity. CA Pankaj Tiwari is a director in CNK and Associates LLP, is qualified as a chartered accountant in May 2012, is currently involved in audit and assurance services, along with consultancy services like due diligence and valuations, etc. Previously, he has worked with BSR and Company LLP in the financial services segment. He handles audits under various gaps, that is Ind AS, IFRS, US GAAP, IGAP of listed and unlisted companies in India. He specializes in the audit of banks, NBFCs, HFCs, and other listed companies. He is a member of AASB study group on guidance note on bank audits. He is a member of expert panel of AASB on bank audit. He is a member of Ind AS implementation of WIRC of ICAI. He is a member of core group of BCAS and journal committee of BCAS. He is a special invitee to the Corporate Laws and Corporate Governance Committee of ICAI in 23-24. He has contributed to various publications such as publication on significant audit matters by Center for Audit Quality, that is CAQ, implementation guide on maintenance of PPE register, best practices. He contributes to BCA's journal on global developments in financial reporting and NAFRA Digest. He has contributed to various publications on audit of banking sector by branches and study circles of ICAI. He's a regular speaker on Ind AS, Companies Act, other topics and other relevant topics at BCAS, CIRC, SIRC, and WIRC branches, study circles, and various forums in India and overseas. With this brief introduction, welcome you, sir, CA Pankaj Tiwari. The podium is all yours.
Thank you. Thank you so much, Preeti, for our introduction, and thank you, Vipul and Preeti, and to the entire study circle, for inviting us. Along with me, my colleague Meet will also be there, who will be supporting us during the course of this discussion. And I want to, first of all, congratulate the study circle to organize such a kind of session, which is, traditionally a non, because, many times the study circles or the branches, everything organizes a session on a technical topic. Let's suppose auditing standard, accounting standard. How do you validate whether the financial statement are prepared correctly in accordance with the Ind AS, AS framework, etc. I think this is the first time when a semi-technical topic, I will not call it as a non-technical topic, which has been picked up by a study circle on a very important aspect, that how do you analyze an annual report. So over a period of 2 hours, what has been allocated to us, we will be discussing various aspects of the annual report. It will start with mainly the regulatory framework, which is all around the, on preparation of the annual reports, and we will take through some case studies and all that. Before I come on the annual report and on my, concrete discussion on this topic, I just want to take a step back and look at it that these annual reports, which are prepared by a company on a yearly basis, have evolved over a period. Like Just to give you some example, I mean, just during the course of this research of this topic, I was looking at the HDFC annual report. And if you look at the HDFC annual report in today's situation, the HDFC annual report runs into 500 to 600 pages at a minimum. Now, if you look at the SDFC annual report in the year when they started their operation, let's say 97, 98, 96, the annual reports were only 20 pages. 20 pages annual report has evolved to 590, 575, 600 pages. What has changed? There are a lot of information which are presented in these annual report. The session will give you some idea, some tips. How do we read these annual reports? How do you make sense of the relevant information which is there in the annual report? And let me tell you, I mean, I try to correlate this annual report of any company with any political party's manifesto. If you look at any political party's manifesto, you will see, they will always give you that what they have done and what they will do in next 5 years or 5 years, etc. This annual report is exactly like the same. If I have to put it in a very layman term, it will give you some historical information, some financial information relating to a year which has already gone. It will also give you what the company is promising to do in the upcoming future years. And unlike the political parties, they have to come out every year. They have to make promises every year, so they get assessed very regularly as compared to a political party. And these annual reports, let me tell you, my friend, contains a lot of financial information and a lot of non-financial information. It is very important for us to understand that which financial information is relevant as a user for me and which non-financial information is relevant as a user to me. So in whole set of information which is provided to the company, because as a company, these annual reports are not addressed to one person. These annual reports are addressed to lot many people, and we will see what are the users of these annual reports when we go ahead in the presentation. So before we read any annual report, one question or one important point which you should keep in the mind, that what are you looking for? Are you looking for a financial performance of the company? Are you looking for a governance structure of the company? Are you looking for a future outlook of the company? Or are you looking at, is there any lapses which is there in the company, which as an investor I should be aware about it? So first, whenever you read any annual report, you need to identify some key questions which you will be looking or finding it in the annual report. And then it will become a very objective assessment for all of you. Otherwise, it will go through a flipping the pages of 500, 600 pages and finding some information in the annual reports. So let's get into the topic of the analyzing an annual report. I mean, reading is done by everybody, so that's why I had kept the topic only on the analysis and not on the reading, because reading is, everybody can read hundreds and pages on the annual report, but how do you make a sense of this information? Either you are an investor, or you are an employee, or you are a creditor of the company, or you might be a current auditor or a prospective auditor of that company. And this is how the whole session of today's, just to put it in perspective, is divided into four parts. uh, First is that we will just discuss some of the regulatory framework related to an annual report, because it is very important for us to know that how these annual reports are created, or how these annual reports are developed at first instance. Then we will be getting into some of the red flags which you could identify from reading of these annual reports, and we have couple of examples relating to that. Then we will be also discussing some of the case studies which we have picked up, where we will show it to you that what are the key information which are presented in the annual report, what is the relevance of those information from a company perspective. And then we will be discussing some of the AI tools which are available by the institute, which could be used by a practitioner or an investor in their regular course of analysis and regular course of discussion, which can be picked up by them, which can be used by them as part of their analysis. And these are very, very helpful tool available to all the chartered accountant free of cost, and I will show you that how you can use that information in public domain. Now, over a period, as I was talking to you, these annual reports which are there, they have developed or evolved over a period. Now, this was one of the study which was done by the PwC, a global investor survey, where typically, the question was that, are you happy? Are you okay with the kind of information or the disclosure which is provided in the annual report? And you will be surprised to see these numbers. I'm not surprised at all. I'll tell you very frankly that 55% of the people are saying that, okay, they are moderately familiar with the company's disclosure. These language which are used by the surveys are very funny. Moderately familiar. That means 55% are at least aware about the disclosure which are given in the annual report. And 45% are not even aware about the disclosure what is given in the annual report. And 63% are aware about some regulatory disclosure given in the annual report. Because if you look at it, these four companies which have put it in the public domain, SDFC has 585 pages of annual report. Unilever has 229, Wipro has 502, and HPCL has 389. So we picked up respective industry just to see that whether there is any consistency. Because if you look at the annual reports are driven two ways. One is that what the management wants to communicate to you. It's a management views which are given in the annual report. There are certain set of section of the annual report which contains only a regulatory reporting, director report, corporate governance report, so on and so forth. So it is very important for us to understand that which section is important as an investor, which I should be reading about it. Now, if you look at the relevance of these annual report, I think this is very clearly, presented all the time and everybody is aware about it. However, I just like to reiterate it. This is one source of this is a what you say, a principal source of an information about all the developments in the company which has happened over a period. Let's suppose a company has opened a new subsidiary either in India, outside India. A company has opened a particular got into a new segment of the business. It will be reported in the annual report, so on and so forth. So if you want to get an information, complete information about any subsidiary, this becomes a one of the document to say that where you can look for all the information. Another way to look at it, and this is what I'm saying, that why the annual reports are relevant. See, many a times, we look at the annual reports, we try to see their colors, their pictures and everything. The relevance of the annual report need to be established at the beginning itself. Second point is that this is a report card of the company. As I was telling you, the chronology which I draw, the company will give its performance of the present. The company will also present its views on the future. So this is like a report card of the company. They also give the future outlook about in which entity or which segment they are going to get into it in the future, and what is the performance of the current segment of the company, etc. And this also reflects the financial health and the corporate governance culture in the company. Like some of the section which we will talk about in the upcoming slides will give you that how you can identify the health of a corporate governance structure. You will have all the independent director in all the companies. You will have audit committee in all the companies. How can you see that whether these committees are effectively doing what they're supposed to do, as a responsible committee members, etc. Quality versus quantity of the disclosure. This indicate the level of transparency, whether the company is, the annual reports are flooded with the information, but whether those information are relevant from my perspective or whether those information are just given because the regulatory requirement is there. And of course, this is regarded as a very reliable source of the information. And this obviously is used by the investor from the decision making perspective. On this slide, what I'm trying to tell you all, my friends, is that everybody is aware about the relevance of the annual report. Everybody is aware about that why these annual reports are required. However, when we get into an investor, when we wear the investor hat, we only look at the financial performance of the company. The financial performance are a historical information which is presented in the annual report. The MD&A, which we'll speak upon, or the corporate governance culture only decide that how the company will perform in the future. So my sincere suggestion to all of you would be that, you should look at the financial performance of the company, no doubt, but you should also pay a lot of attention on the governance structure of the any company or any entity, whichever, you are looking to evaluate from a annual report perspective. Now, who are the users of the annual report? And I would like you to focus on the cartoon which is put on the PPT. And this is a very important one. Who are the users of the annual report? The investors are the user of the annual report, obviously, yes, because they are looking at a prospective investment to come up in the future. The lenders, like I, for example, I do a lot of banks, and these banks analyze the financial statement in a great detail, and some of the insights I will provide as we go ahead in the presentation. So investors are the users of the financial statement. The lenders are the user of the financial statement. The creditor, they look at the solvency of the company, to whom I'm supplying the raw material, to whom I'm supplying the services, whether the company is solvent or not solvent. The regulator, I mean, half of the pages of the annual report, if I can say, is prepared only to comply with a regulatory requirement, because the director's report are regulatory driven, the financial statements are regulatory driven. So a lot of information is also provided to the regulators, rating agencies, and employees also, to look at how their companies are performing, what is the growth of the company, rating agencies to evaluate it, what is the current rating of the company, what are the future outlook which is provided in the management discussion and analysis section. And I mean, if you look at all these information which is presented, and as a user, if I have to say, a lot of these annual reports provide a lot of information, but there is no correlation of the information amongst the two. So what we will try to do over a course of our presentation, we'll try to correlate them also, that how do you read the two section of an annual report together to come up with a logical conclusion, basically. Now, first point I would like to address, and this is the start of our session, to go into the deep dive into what is the basics of the annual report first. Now, if you look at annual report, there is a definition which is available in public domain. Everybody can read the definition. I'm not going to get into it, because it's very simple, that it provides you an entity's outlook on the entity's operation. It provides you the entity's financial results and position. Now, in India today, all of you would be aware about, there are two sets of annual report which gets prepared. So I want to address that point first. What are the two sets report? If you open any company's report, you will find some companies writing integrated annual report. Some companies writing only annual report. Now, as a user or as an investor, you will get confused that what is the difference between an integrated annual report and an annual report? What is the information which is provided in the integrated annual report which is not there in the annual report? And why two listed company can prepare different type of report, first of all? Because both of the companies are listed on the exchange, ideally they should prepare an annual report which is applicable to everybody. So let's address this point. If you look at all the companies, taking a step back, look at the companies which are registered with the MCA, and we are focusing only the company which are limited by the shares, because this discussion is revolving around that set of entities. You have around 18 lakh companies which are registered with MCA, which are limited by shares, basically. Out of that, you have 70,000 public companies and 17 lakh private companies. So if you look at it, the larger proportion is of the private limited companies whose annual reports are not available in the public domain, basically. Out of the public company also, you have a listed and you have a unlisted public companies. Listed companies are around 6,000, which need to comply with all these SEBI regulation, with LODR regulation, etc., etc. And unlisted companies you have. So our discussion today will be mainly focusing upon these listed entities whose information is already available on the public domain. Nevertheless, to say that the similar kind of analysis can also be performed on a unlisted company's annual report also. So the kind of the analysis what you will do on the annual report of a listed company, you will do on an unlisted company also. So the annual report in today's situation by any company. So I'm just taking us one step after the other. So you understood that there are two sets of annual report which is prepared today. One is the integrated annual report, one is annual report. We are trying to understand that why there are two sets of annual report existing today in India. So we have to go to the structure of the annual report, how it is getting prepared, which we are trying to address through these some slides. So if you look at the annual report, as we said, there are listed companies, there are private limited companies. My friend, listed companies need to comply with the Companies Act, because that's a primary regulatory requirement applicable to any company which is registered in India. So you have section 134, which primarily talks on the requirement of the regulatory requirement of the annual report. Then you have a SEBI LODR, regulation 32, regulation 34, and some schedules of the LODR, which gives you that what should be the content of the annual report. Because if you find entirely in the Companies Act, you will not find a term called as an annual report under the Companies Act. The SEBI LODR prescribes that every listed entity need to submit a copy of the annual report to the exchange. So I'm getting into a listed company, listed public company, which is listed on a stock exchange. So you have a regulation 34 which need to be complied by a company. That regulation requires a company to submit a copy of an annual report to the stock exchange. And the same regulation, the sub-regulation 2 also prescribes that what should be the content of these annual reports. They say that, okay, you attach financial statement, you attach audit report, you attach director report, so on and so forth. That regulation has a subclause 2, which has a clause F, which says that a top 1000 listed entities in India based on market capitalization need to submit a BRSR also. Business responsibility, sustainability reporting you need to do basically, which is mainly in a common layman term, we call it a ESG reporting. So this information, when this is clubbed with the financial statement and director's report and other information, is called as an integrated annual report. So the companies, top 1000 listed companies who are there on the stock exchange, as on today, it is mandatory for them to prepare and present integrated reporting as an annual report. And why this is relevant from the user's perspective, my friend? Because whenever you are providing any information relating to the ESG, it also has a financial consequences, which we will discuss. It's not only, giving a nice information about how you're going to reduce the carbon, how you're going to reduce the water, etc., etc. But it also need to be evaluated what will be the financial impact of these information on the company as well. So just to address it very clearly, the integrated annual reports are prepared as on today by top 1000 listed companies who are there in India. And normally, other than those companies, are required to prepare an annual report. So it addresses the first point which we had discussed, that what are the different types of annual reports existing today. You have an integrated report, you have an annual report which is there in India. Now, this regulation also requires a lot of other information to be disclosed, as per Schedule 5 of the LODR. Then you have other regulation. There are two, there could be two set of listed companies. One set of listed company which have just listed their equity. There could be another set of listed company which could have listed their debt as well on the stock exchange. So the regulation 53 talks about what are the disclosure or what are the content of the annual report which is required as per the regulation 53 of the SEBI LODR. So whenever you are analyzing or you are taking any annual report in your hand, just be very clear that what kind of reporting has been done by the company. Because your reading or the information which is getting disclosed in these two annual reports should be different. You can't compare one annual report which is given by a private limited company vis-a-vis an annual report which is given by a listed company, because they are driven by a different regulatory framework altogether. So, like for example, the Schedule 5, which I just spoke about on the SEBI LODR, both for debt listed as well as equity listed, requires you to give a lot of information. Like for example, management discussion and analysis gets originated from there. Your corporate governance report, which is one of the important regulatory report, gets originated from there. And your compliance certificate, which is given by mainly the auditor or the practicing company secretary, gets originated from here. So what I'm trying to tell you, my friend, is that whenever you are looking at any annual report, before you go into reading the annual report, first you should understand the basic framework of these annual reports. Then only you will be able to appreciate that why this information is contained in these annual reports. And similarly, and these all were applicable to listed companies. Similarly, you have section 134, which is of the Companies Act, which prescribes a kind of a layout for the annual report, basically. it says that these financial statements need to be approved by board of director, MD, CEO, and you should attach an auditor's report to the financial statement, and then you should have a director's report which should specify a lot of matters. So unlike the SEBI LODR, which very clearly prescribes that okay, these are the things which should be there in the annual report, you have section 134 which gives an outline kind of a thing which need to be complied by all the private limited company, and it is also supported by rule 8 of the company's account rules, which requires you to give a lot of information on the board report. So when you read the annual report, my friend, you will bother that why these information. Sometimes you question that why these information are required to be given in the annual report. Like for example, one of the information in one of director's report you'll find about something related to electricity consumption, etc. Because it is coming from a Companies Act, or it is coming from Rule 8 of the Companies Account Rule itself. All the information what is getting disclosed in the annual report at a minimum has some regulatory requirement, my friend, and that's why it becomes important for you to understand that what are the what is the background of these information which are getting published in the annual report. Now I'm going one step ahead, my friend. Now what is the content of these annual reports? If you look very frankly, I mean, if you have to divide into 2 to 3 section, I'll tell you some section talks about more about the company, basically, like what the company does, what is its operation, what are its presence, what are its key performance indicators, so on and so forth. There will be one section which will be talking about more on the performance of the company, basically how the company has performed over a period, how the company is looking at in future, what will be the growth perspective, what are the risks which the company is running with, which is mainly included in the management discussion and analysis. This is the like I call it as a heart of any annual report, my friend, because this is one of the key document wherein the management communicates to you basically a SWOT analysis, their strength, their weaknesses, what opportunities they have, and what threats they are going to face it over a period. So the MD&A analysis is a very important part of an annual report, which everybody should look at it. Then there would be a section of the annual report which will contain mainly the statutory reports. Like for example, what we just spoke about, the corporate governance report. There is a corporate governance format which has been prescribed wherein the reporting will happen. Then it would have a director's report, basically. Then it could have a financial statements, auditor report, etc., etc. So there are various sections of the annual report which are given, which are addressed for a particular reason, either regulatory or from a management perspective. We should be aware about as an investor that what information I should be reading it. And as and when we go ahead, we will come to know that which information is critical to read and which information. If you divide an annual report, there are two sections of the annual report as I look at it. And as I tell everybody, one is good to read and one is must to read. You should be aware about what is must to read. It is okay to have a section which is good to read also, but there are certain section which is must to read in any annual reports. Now before you get into reading any annual report, my friend, so till now what we have understood is that there is a basic structure of the annual report. There are different types of annual report: integrated versus non-integrated, or integrated versus plain annual report. Then the annual report also depends upon the content, depends upon what kind of entity you are, whether you are a listed entity, whether you are unlisted entity, so on and so forth. Now, before you read any annual report, my friend, you should have at least some basic knowledge on the company per se. And I'll tell you why they are required and why they are relevant also. One is this applicable regulatory framework. We spoke on one framework, which is integrated annual report versus annual report, which we have already discussed that top 1000 companies based on the market cap, they need to present an integrated annual report. Listed versus unlisted. Why this is relevant, my friend? Because as you know, in listed entities in India today need to comply with the Ind AS framework. Whereas, except some exception with respect to banks and insurance companies, etc. Barring those entities, largely all listed company need to comply with the Ind AS framework. Whereas unlisted companies need not comply. Unlisted company could be there on the IGAP framework also, which is Indian GAAP framework. Now, there's a vast difference between these two frameworks, because one framework requires to do a fair valuation accounting, another framework requires you to do a historical cost accounting. So if you are reading an annual report and that annual report is under an Ind AS framework, the way you will read a financial statement would differ, because you will like to find out that if the profit is rupees 100, how much of that profit is coming from a fair valuation gain, and how much of the profit is coming from an actual operation. Whereas if you're reading an IGAP annual report, you don't need to, work on this matter as such. So it is important for you to understand that which framework the company is currently reporting, whether it is reporting in Ind AS or whether it is reporting under IGAP. Then applicable financial reporting framework, which is IGAP versus Ind AS, which we just discussed. Now, sometime what happens, if you are reading an annual report of a company, the presentation could differ. For example, there are three divisions of Schedule 3. I mean, Schedule 3 is a format of the balance sheet. Division 1, Division 2, Division 3. What Division 1 is applicable to normal accounting standard companies, which are not under Ind AS. Division 2 is applicable to Ind AS companies. Division 3 is applicable to NBFC company. And my friend, if you see the format of these financial statements, they're completely different. So you should be knowing the entity which you are gonna read the annual report, whether it is in Division 1, Division 2, Division 3, because then the presentation of a asset, presentation of a liability differs in all these frameworks. So you should have a knowledge of that, whether it is reporting in which division of my Schedule 3. And I tell you, that's why, people say that it is very complicated. You can't make any sense of the financial statement. Only because, there are some basics which need to be very clear before you go and read the annual report. When there are some applicable sector specific reporting requirement. Like, for example, the way a NBFC will prepare a financial statement, it's not necessary that the same way the bank will prepare its financial statement, because the format of the bank is the financial statement of the bank is driven by Banking Regulation Act. So they will have a different format of the report, and I will discuss some of the example of those reporting also. Whereas where you will find a difference between the two. Then similarly, you have IRDA, which prescribes the format for an insurance company. Then Electricity Act, which prescribes the format for electricity companies also. So you should be aware about the entity which you are reviewing. Let's suppose you are reviewing the HDFC financial statement. If you're reading an annual report of HDFC financial statement, you can't equate with the HUL financial statement or an annual report of HUL. Number one, because they are into two different industry altogether. Number two, they are, I mean, the benchmark which will be there will be completely different for both of these entities per se. And another important point is, my friend, which you should be aware about is that what is the additional applicable regulatory requirement on these companies? Whether CARO is applicable, and I'll tell you the relevance of the CARO in today's situation. I'm in the audit domain. I know what is the importance of the CARO, and it gives lot of insights into the financial statement of the company, which we will discuss very soon. And then any additional direction which is given by, like for example, in case of government company, you have an additional direction which is issued by CNAG. So what I'm trying to do, my friend, or what I'm trying to suggest you all is that whenever you are gonna go and read any annual report, have these 4 to 5 things very clear. Whether the company is in Ind AS, if it is in Ind AS, then what is the impact? If it is in Ind AS, then you would have a fair valuation accounting, which you need to factor in before you analyze the company. The financial reporting framework, the presentation differs, so the reading differs. Then specific regulatory or specific sector regulation implication, then I need to evaluate it differently. CARO 2020, I will get a lot of insights into the company if CARO is applicable, mainly from the culture, governance culture perspective. And then if there is any additional disclosure, all these will give you some or the other inputs when you go and read these annual reports, my friend, in future. Now, what are the critical areas of the annual report? As I said, I have divided this into two parts. One is good to read, one is must to read. Now, these pin which I have done, I mean, the financial performance, the mark which I have made, these are must to read information, my friend. I mean, without reading this, you can't make head and tail of any entities or their financial performance at least. One is this financial performance. In any annual report, my friend, there will be a financial performance of the company. Many a times it get missed because it is, presented with lot of other disclosures. You should identify that where the company has presented its financial performance. And let me tell you, this financial performance is not the financial statement which is presented in the annual report. The financial performance deals with at least 5 to 10 years financial performance. Now, if you look at any annual report, you'll find that company comparing its performance of the current year vis-a-vis 5 to 10 years. It will show you the profitability ratio. It will show you the current ratio movement. It will show you the quick ratio movement. So that is one of the section which will give you that how the entity is performing year on year basis, and what will be the relevance of it, because it will also give you lot of key industry ratios which are applicable to it. Like for example, I mean, just from example perspective, if you look at the DMart, if you look at the annual report of a DMart, it will give you financial performance. It judges, is one of the parameter of the financial performance judges, is that how much revenue they have generated per square feet of a retail shop or the DMart shop, what they have opened it. So that is one of the industry parameter which you can compare with the other retail industry and can come to know whether they are doing good or they are not doing good. Like other example could be a banking company. They present a lot of their information with respect to the default loans, whether their default loans have reduced over a period or their default loans have improved over a period. And this would differ bank to bank because there is no standard a benchmark which is there. So these kind of industry ratio will also help you to understand, to analyze the financial performance of a company. Another important point, which is normally presented in all the listed entities, so to say, a performance of their business segments. And this is very important and very relevant because it gives you a lot of insights. If you look at the profit and loss statement, my friend, you will find one P&L. But from which business this profit is getting generated is given in the segment reporting. And that's why always I say, that the financial statement or the profit and loss statement is just like a face of a financial performance. If you have to really look at it, what has contributed how much to this profit, you should go to the segment reporting, which will give you a business segment, which also will give you a geographical segment. It is very important to know any entity whichever you like to review or you like to see the annual report, that from which country they are generating the business. Because in today's geopolitical situation, my friend, it is very important to understand the risk where it is residing, whether the company is generating all its revenue in India, I mean in domestic market, or whether the company has a dependency on the export market as well. And this will be important considering today's situation which is there as such in the world. And these are must to read financial performance section, my friend, in the annual report, because this is very relevant from analysis perspective. Another one of the important which I was talking, which is the heart of any annual report. And if you really want to understand, forget as an investor, if you really want to understand an industry, what you should look at it, go and read particularly any good company in that sector. Like for example, if you want to understand banking company, or you want to understand IT company, or you want to understand a petroleum company, you look at the financial statement of HDFC, Wipro and HPCL, and go and read their management discussion and analysis. One, it talks about the company, that how the company has performed. Another, it talks about mainly the financial industry performances also. So if you want to understand any industry in particularly, you should just pick up the annual report of any good company from that industry and read the MD&A section of that company per se. And this discusses a lot on the financial parameter, and any changes in those financial parameter, or there is significant changes in the whether there is an increase in the profit, what is the reason for that? Decrease in the market share, what is the reason for that? Increase in the market share, what they have done better as compared to the others? that's why their market share has gone up, so on and so forth. One of the important point of this MD&A section, which at least I as an auditor or I as an investor look at it, my friend, is identification of growth potential and the risk which is there in any company, which normally we call it as a SWOT analysis, which I was talking at the beginning. What it does, my friend, it identifies that which are the areas in which I want to grow, which are, and what is my strength, what is my weaknesses, what is the opportunity I have. I might have captured a particular area of a market, but I want to capture other areas of the market. So it gives you a lot of insights into the future performance of the company or a future outlook of the company. So any company, whichever you are planning to read the annual report, please look at the MD&A of the annual report, my friend. I mean, a very, very important section. And as I said, the auditor's report and the financial statement are a reflection of the financial health of the company. For example, if you look at the annual report, again, the auditor's report, again, the auditor report could be three types of report. And it is very important for you to know what report to read to get what kind of information. Like, for example, if I read a financial statement report, my friend, opinion on the financial statement, let me tell you, I mean, coming from an audit background, it is a template driven report. I mean, if you compare five companies, you'll find the same kind of a reporting everywhere, unless and until they have qualified the opinion of any particular company. And if you look at the IFC report, this is also a very standard template driven audit report. But if you really want to understand any company's uh, one, financial health, another is the governance culture, related party transaction, loan given to group companies, anything you want to understand, whether there is any red flags in these areas, one of the report to read is the Caro report. After Caro 2020, my friend, and I will discuss it in further also. After Caro 2020 coming into play, and after amendment in the Schedule 3, which was done by the MCA, the information which is coming in the public domain is substantially, a good quality information. Like, for example, there is a complete whole section in the Caro where you need to comment upon the loans which are given by the company to its group company, or the investment which is done by one company to another, to its group company, or whether there is any loans which are given which are interest free, or any loans which are given to the subsidiary which have been subsequently written off, or you have given a guarantee on behalf of a company, a group company, or you have pledged the shares to give the loan to another group company. So, if you really want to read the annual report, my friend, or audit report, the important points gets covered in this Caro report, my friend, and it will give you a lot of insights into the company, and I will discuss some of them. Another is a key audit matter which is presented in all the annual report. Now, why should I read the key audit matter of any auditor's report? The key audit matter, as a user, I should be aware about that if the auditor has spent 100 hours on any particular engagement or an assignment, what is the matter where he has spent most of his time? And that is how, in a layman term, the key audit matter gets decided. Like, for example, if a company has a lot of inventories, or if the company has a lot of trade receivables, whether these inventories are correctly valued, whether these inventory are, reflected at the realizable value, or whether these inventory will fetch me the correct value, or the receivables which I have shown in the balance sheet are correctly reflecting. There is no doubtful receivables which is currently shown in the balance sheet which is not been provided for. Lot of these matters where the management would have used a lot of judgments and estimates become part of the key audit matter. So whenever you are reading any auditor's report, and when you look at the matter which are given in the key audit matter report, you should always look at it in a different lens altogether, because that is a matter which the auditor wants to tell you that where he has spent most of his time, or where the management has used a lot of judgments. And whenever the management uses a lot of judgments, you and me both know that there could be a management bias which could be there. So that's why that's a relevance of the key audit matter section in the annual report. And as you know, my friend, You have a financial statement, which all of you would be, going through reading on a day-to-day basis, which normally has a balance sheet, profit and loss account, cash flow. And now if you're a company which is under Ind AS, you have a SOCI statement, which is nothing but a statement of changes in the equity, so to say. Then you have notes to financial statement, which is mainly on the, a lot of disclosures are given in this financial statement. Then consolidated financial statement is also presented. And let me tell you, the entire focus is suddenly shifting on the consolidated financial statement, my friend. And people who are tracking this information, tracking this development, would be aware that there is an increased focus on the consolidated financial statement. A lot of financial statement about the group information on the group companies, which we will discuss why they are relevant. Now, just quickly, I want to tell you on one matter, that in the audit report, you, as a user, you should be aware about, as a reader, you should be aware about, my friend. You have a financial statement which is audited and reviewed by the statutory auditor of a company. Then you have a whole lot of other information: your corporate governance report, your directors report, your MD&A analysis. Let me tell you, my friend, from 2008, from financial year 2018-19, this information is also subject to review by the auditor. What do you mean by review by the auditor? The standard on auditing has mandated to all the auditors of the company to review these information which are presented either in the director's report, or management discussion and analysis, or it is presented in the corporate governance report. At least the auditor should read them, so that there is no false or misleading information which is given in the, in the annual report, or to say, so to say, in these, management communications, basically. So, like, for example, if I'm saying my PAT is 1000, and the PAT as per the financial statement is 950 or 960 or 900, why there should be inconsistency between the two? So from 1819, it has been mandated for the statutory auditor that you should review these other information which is getting presented in the annual report. And my friend, this gives a weightage to these other information, because, if you are aware that this other information has also been subjected to one kind of a review by the statutory auditor, you will rely more on that other information, because you will say that, okay, somebody has looked at this other information, and somebody has, confirmed that the figures which are presented, current figures, not the, projections and all that, the current figures which are presented in these annual reports are somehow, tying up with the financial statement, so to say. So this is nothing but just to provide extra comfort to the user of the financial, user of the annual reports, my friend. And this is started from 1819. However, as you know, if you read the annual reports of the companies, you will find two sets of reporting happening today by the auditor. One will say that, yes, we have read it and we have nothing to report in this regard. That means he is very much comfortable with whatever other information is getting presented in the annual report. Another is that the annual report is not available only to me as on the date of signing this audit report. So how can I comment upon it? Because many times what happens, these management discussion and analysis, these directors report are under preparation. They are not finalized up to the date of the auditor report, kind of a thing. So what they say, that these reports will be made available to me after the date of the audit report. Now you will ask me, Pankaj, okay, why are you telling me all these things? What should I make a sense of this information? My objective is only to tell you, if other information is subjected to review, or it has been reviewed by the statutory auditor, as a user, I will rely more on that other information. When the other information is not subjected to review, or not subjected to at least one set of confirmation from the statutory auditor, I will have my own diligence to, look at those other information. So it only provides a extra comfort to all of you. So, my friend, till now, what we have just discussed, we have discussed mainly around what are the basics of the annual report, what are the different types of the annual report, what is the regulatory framework around this annual report, and what is this, what are the various critical section of the audit, annual report, which as a user I should be aware about it, and what is the, pre knowledge I should have whenever I go to read the audit report. Now, you will ask me, Pankaj, okay, you tell me, if I am looking at any annual report, how do I identify a red flag? See, nobody can predict the future, to be very frank. I mean, if everybody would have predicted the future, we would have not seen what is happening in the market as such. What we can do is that reading these annual reports, we can identify the red flags. And these red flags can give you an indication that there is something wrong in this company, or there is some problem in this entity, so to say, basically. Now, what are these red flags basically? Let's look at them one by one, my friend. Let's spend some time on reading it. One is that core business. Okay, how much time a entity or how much time the management is spending on its core business. Like for example, there is a change in business strategy on year basis. I was doing a manufacturing activity of a clothing. Suddenly, I will get into a trading. Suddenly, I will shift my strategy to some other business. Suddenly, I will open up a different segment altogether. So, how much the management is focusing on its particular, industry for which the entity has been created. A very, very good example could be a Kingfisher. If you take Kingfisher, they were particularly an airline company. They ventured out into so many businesses that the focus or the fund which was required for the airline company was routed to some other business activities, so as to say. If you look at some of the other entities which have failed, this is primarily because the money which was raised for core business activities were diverted to some other activities, so as to say. So one red flag could be that are you changing your business activity on year basis, or what is the vintage of the current business activity which you have entered into it, or which you are you are currently engaged into it. Another is that new products and new segments. My friend, I'll tell you very frankly, before you launch a product, or before you get into a new segment, you should have at least spent a good amount of time in that in the old product or the old segments which you are venturing into it. Like for example, let's suppose I am engaged into a business of a trading in the clothing business, or I'm doing a trading of a cloth. Now, if I have to set up a factory of manufacturing entity, first I should be aware about the basic tricks of these industry, then only I can set up a manufacturing entity. So before you venture it out into a new product or new segment, how much time you have spent into it, allocation of capex into uncharted territory, which I just spoke about. One of the important indicator which one can look at is that percentage of assets which are pertaining to non-core area. Like for example, I am a manufacturing entity. Okay, investment could be only a surplus for me. That means if I have extra money kept in the bank account to make a good returns on my ideal money, I can go and invest into a stock market. I can go and invest into GSEC. I can go and invest into T-bills. But my percentage of the asset which will be of these investment can't be significantly higher as compared to my manufacturing assets, basically. If that is the case, then there is a serious issue with that entity. So how much percentage of the assets are pertaining to non-core activities? Because non-core activity does not generate the operating profit for you. And that is why the assets which are pertaining to non-core activities are very critical and very relevant. Another way to look at it, my friend, or another area to look at it. So first is that how much of the time the management is spending on its core business, basically. That how much time they are spending on my current business strategy, how much time, or they are changing their business strategy on a year basis, so on and so forth. Another is to look at it that business expansion. Are you acquiring, or is the company which you are evaluating or you looking at it is an asset which is not gonna facilitate the existing business? Like for example, I've just given one example that a manufacturing firm is buying land for development of commercial complex. Now, whenever you do such activity, what are you trying to do? You are trying to divert your focus from one activity to the other activity. And if your the existing activity is not stabilized, you would have a lot of what do you say, a resource dilution or a diversion to a new activity. So this is also one of the red flag, that if an entity is acquiring certain investment which are not facilitating or not supporting my existing business activity. Now, this is a very critical and very important, that if you're setting up overseas subsidiary without any rationale, like for example, somebody has told you that, okay, there is a good opportunity in Indonesia market, there's a good opportunity in Dubai market, in the Middle East market, without doing an actual market survey or without doing an actual research, you are setting up shops over there. How would you know? I mean, as a investor, how would I know that whether this the subsidiary which have been set up in the overseas is after the market research, or after the because the management feels it could have a potential in uptake in that country. It is very important whenever any company sets up any subsidiary overseas, it provides a rationale to you. Like for example, if I don't have presence in Indonesian market, if I don't have a presence in Middle East market, I am just setting up my shop to have a presence in that market, which is fine. But if you're planning to do some import export transaction from that entity, then it will have its own complication, it will have its own issues as such. Another is that whether the entity has identified the risk, and whether the entity is providing you sufficient information to address those risks in their management discussion and analysis, my friend. Consistency and commitment. And this is a very important, and particularly if you listen to any of the investor call or investor presentation, you will come to know that if the entity, if there is no discussion on the plan which was discussed in the earlier period, like for example, in the earlier period, you had communicated to the shareholder that yes, you would have capex approximately 1,000 crore, which will generate an additional capacity of x metric ton, and which will result into a revenue of xyz figure. Now suddenly there is no discussion, or there is no update on those promises what was made in the past on the to the shareholder. Now this raises a red flag, because what you are doing, you are just promising in year one, but you're not following up on that promises in the year two. So this could have, I mean, I'm not saying that it is necessary for all the entities to provide an information, but these are the areas which could highlight the corporate governance culture in the organization, that nobody is addressing or nobody is providing an update on what was promised in the past. Now, if you look at the corporate governance, which we just spoke in the beginning, my friend, if you have to evaluate the corporate governance culture of any company, you look at the composition of its board of director, how much independent they are, and what are the expertise they are having in the segment. Like for example, just sharing one example with you. Like for example, if you look at the composition of the audit committee, right? Now, composition of the audit committee is the audit committee is the most important committee in any organization. Why? Because it approves results, it appoints auditor, it also takes various strategic decisions which subsequently recommended to the board. Now if you have an audit committee chairman, or if you have an audit committee composition which is not too much familiar with the financial statement or with the financial information which is getting presented in the annual report, there will not be a positive contribution from these committees to the to the company, so as to say. So whenever you have to evaluate the corporate governance culture of any organization from the annual report, you should look at it, what is the composition of board of director, what is the expertise, what is the experience, and how much independent they are to the company. Audit committee, you can look at it, the chair, who is the chairman of the audit committee, what is his qualification, what is his experience in the finance field, and how much time he has spent in the company to become an audit committee chairman, so as to say. Then remuneration which is paid to the director versus an employee. There was a very famous case, if you all aware, where 80% of the total remuneration was paid to the director, 20% of the remuneration was paid to the employee. So as per the regulatory requirement, every company has to present its remuneration which is paid to the director in the annual report. So if you look at it, that the remuneration which is paid to the director is significantly higher as compared to the employee, it will give you that, okay, whether you are fair, where you are compensating your employee fairly, so as to say. Then attendance of these director in the respective meetings of the board or audit committee, so on and so forth. All this will tell you what is the boardroom culture, my friend, in any organization. What is the boardroom culture? If the management or if the committee members are not attending the audit committee, or if the board of directors are not attending the board meeting, etc., it raises a red flag that why these people are not attending the audit committees. Another is that financial statement, so as to say, basically, if you look at the financial statement, my friend, this is one of the important area to look at it and to analyze it. Now, as of now, till now, what we have looked at it, that whether there is any red flags from the information which is other than the financial statement. Now, if you look at the financial statement, what are the red flags? There are many, many, many red flags which one can identify from the financial statement. And my friend, these red flags which are there, they are mainly on the financial performance. The red flags which we were talking earlier, mainly on the business activity, on the expansion and all that, this is more on the business strategy of the company. So you need to differentiate between the two. Now, if you look at the financial statement, whether the margin of the entity is declining on year basis, maybe you are profitable, but whether you are maintaining the operating profit margin what is there in the industry, or if no, then it's a red flag for me. Dependency on non-recurring gain for profits. Some entities, they try to structure their profit and loss account, and having seen the financial statement of various companies, let me tell you, some of the acquisition and some of the disposals are planned so as to reflect a certain profit figure in the financial statement of the company. So, whenever, my friend, you are analyzing any profit or loss account of any company, what you should always look at it whether there is any one time gain which is there in the financial statement. If there is one time gain in the financial statement, that should be carved out, and then a like to like comparison should be done from the financial statement. And you will find this quite often now, considering a stress situation in the corporate, considering a slowdown in the industry, you would find many different tools to get the profit number which could be comparable, or which gives a face saving to the management, basically. So if you're reading any financial statement, try to identify whether there is any one off or whether there is any one time income which is there. Another important area which one should look at it, and which particularly important from a manufacturing company perspective, I can tell you, is cash to cash cycle, basically, which is mainly called as a working capital cycle. Whether your working capital cycle is increasing or whether your working capital cycle is decreasing. If your working capital cycle is increasing, it will significantly deteriorate the financial health of the company. Because what is happening, your large chunk of money is stuck into the market, mainly maybe into the form of inventory, maybe in the form of trade receivable. So whenever you are evaluating any company, my friend, try to identify what has been the operating cycle of these entity, and this can be easily evaluated or easily determined. Very simple, doing two ratio analysis: the inventory turnover ratio and the data turnover ratio. If you do an inventory turnover ratio and if you do your data turnover ratio, it will give you good insights that whether your working capital cycle is increasing or whether your working capital cycle is decreasing. And let me tell you, when as a auditor of a bank, if I look at any files of a company, this is the first point which we pick up. That if you have funded a working capital facility to any company, how have you evaluated the working capital cycle of a company, and how the working capital cycle has evolved over a period. So, and this is very typical for a manufacturing company, my friend. Look at the working capital cycle. Means when they are acquiring an inventory and when they are, getting the realization from their data, so to say. Negative operating cash flow, and this is an important one, and I would request all of you to focus upon this. What happens, my friend, in today's situation, as we were talking about, many a times your financial statement shows a very good profitability number. Why? Could be because you are under a Ind AS framework. Could be you are following a fair valuation accounting to account some of the fair valuation gain into P&L. The cash flow becomes a very critical item then, because cash flow is nothing but how much cash has come into the company and how much cash has gone into the company in a layman term. So profit and loss may show you a good rosy picture of the profit. But when it comes to looking at the operating cash flows, you would see that the operating cash flow of the company is a negative, whereas you would have a profit in the P&L account. So my sincere request and suggestion to all of you would be, and that's what I follow, if you are having a company which is following an Ind AS framework, please, please, please focus more on the cash flow than on the P&L account. Because the cash flow will give you a real good picture on the financial health of the company than the profit and loss account of the company. So please pay attention. Look at what is the operating cash flow of the company. What is the comparison of the operating cash flow over a period, so to say, and look at it whether there is the negative operating cash flow basically which has been which is there. Maybe the profit has been reported as per the P&L account. Another is very because of which many entities have failed in India is short-term funds is used for long-term purposes, my friend. And this you can clearly see from the cash flow statement. Because in cash flow statement, you have two sections, which is cash flow from financing activity and cash flow from investing activity. Cash flow from financing activity is nothing but how much borrowing has been taken from the banks or other parties and how much of the money has been refunded. Investing activity is nothing but how much capital expenditure you have done towards the either towards the project or towards the acquisition of a particular subsidiary or a joint venture or an associate. Look at it, the money which has been invested into capital expenditure, whether it has been generated through short-term sources or a long-term sources. You'll ask me, Pankaj, money has a no color. Once it comes into the bank account, nobody knows from where it has come. But my friend, very simple. You should know what is short-term fund. Short-term fund means if you are deploying or if you are buying an immovable property by using a working capital facility, that is a short-term fund utilized for a long-term purpose. Tomorrow you have to pay that money, you will not have a money because you have invested into a immovable property. And this is one of the big flaw in many entities, that this kind of an analysis is not done on a regular basis. You want to do a capex, you might utilize your working capital facility, but you should have sufficient short term resources also. Whenever this short term liability falls, you should be able to repay that money. So my clear indication or suggestion to all of you is that look at it whether the entity is using short term fund for long term purposes. Rising profit but declining return on equity. This is one of the fundamental issues in most of the industry, which you will find. And look at it, the reason for it. Your profits are increasing, but your return on equity is falling. Could be the reason behind it? Another is that the revenue recognition policy not consistent with the practice. And this is a famous example of Baiju. I mean, people who would be aware about the Baiju. And if you would have looked at the financial statement of Baiju, it is in public domain. I'm not sharing any secrets here. The Baiju was recognizing all the fee income upfront, whereas the obligation to provide a service was over a period of time. And this was a major reason for what you say a loss getting reported in the profit or loss in the subsequent financial year. And if you go and download Baiju's financial statement, you will also find certain restatement done post listing of this company, wherein they had rectified this mistake. So please look at it, my friend, the revenue which is getting recognized by the company, which is whether it is in line with the the service which is offered by the company, or they are recognizing upfront revenue today so as to show profit in the financial statement, whereas in subsequent quarters if the business falls they will not have any income to say that. So look at the revenue recognition. Look at it how the entity is recognizing its revenue in the profit and loss account. You will tell me, Pankaj, what you want me to do? You want me to go to the call up the financial CFO of a company and ask him that how are you recognizing a revenue? No, no. I mean, that's not the expectation, my friend. Look at it, the financial statement. Every company gives a revenue recognition policy in its financial statement. Every company tells you that how they've recognized the revenue in the financial statement. Read it. I'm very sure you will be able to make some sense of that financial information, of the policy. Another way the financial statements are tweaked or so to say managed, it changes in the accounting policy. Now, let's suppose if I have some issue, okay, with respect to my profitability number, can I change some policy? Can I change my inventory policy? Can I change my revenue recognition policy? Can I change my depreciation method? How I'm amortizing? Can I change my policy to say that how I will recognize the fair valuation gain or loss? So if you are reading any financial statement of any company, this is one of the important area which one should look at it, that what is the whether the company has changed its accounting policy over a period, and whether the company has changed its accounting policy frequently on a year on year basis. Another which is a very important and very familiar to all of you is that from the disclosures. So if you all know that there is a lot of disclosure which is made in the financial statement, my friend, which one has to look at it. Now, if there is significant increase in the related party transaction, that's a red flag for me, because all of you are aware about the related party transactions are one of the area to be watch out for, even by the regulator and even by the auditor as well. So if there is any significant increase in the related party transaction without any commercial reason, so as to say, like, for example, there is an increase in the loan given to a related party, loan taken from related party, advances given to related party, advances taken from related party, then it has a issue. It requires a little more diligence as compared to the other. Then what I was talking about, the segment wise disclosure, if the segment wise profit and loss is presented, there's a profit in one segment, but there's a loss in the other segment. But overall, if you look at the profit and loss account, you'll find a profit as per the P&L statement. So it is important for us to know that whether there is any issue in that particular segment or in that particular business, product or a portfolio, so as to say what is the reason for the loss. So that's a red flag if you find this kind of instances anywhere. Another is a geographic segment which we had discussed, that there could be impact of a geopolitical situation. If you are a supplier to a particular countries which are under a tension or under a war situation, this could have an impact on your entity also. Then there is a significant contingent liability or the litigation. Now this is one of the most neglected area. Personally, I have seen it. Now, my friend, what happens, we everybody reads only what is presented in the number format. What is there in profit and loss account, what is there in balance sheet, what is there in the respective schedule. Nobody goes and looks at it, what is the contingent liability or a potential litigation with the entity is fighting for, or a litigation which is still not concluded, and especially which is not provided in the books of accounts. Now, in one of the entity which we were, evaluating it, the contingent liability amount was more than the net worth of the company. So tomorrow, if this contingent liability falls due on the company, the entire net worth will get eroded. So that's a red flag for us, basically. That if you have a significant exposure in terms of a contingent liability, maybe coming out of any income tax litigation or a vendor litigation or a customer litigation, need to be evaluated very thoroughly. Another is dependency on money raised through related party versus banks. Are you taking money from a related party or you're taking money from the bank? What is the reason? You'll tell me, Pankaj, okay, this is good. They are supporting each other. They are taking the money from the group companies. My friend, the reason could be that they don't want to get subjected to a scrutiny by a particular third party. Because if the bank will come and wants to give the loan to company, the bank will do its own assessment. Maybe in terms of scrutinizing the financial statement, maybe in terms of looking at the profitability figures, ratios, etc. So if the company is solely relying on the related party transaction and taking money from another group company, why they are not going to the banks basically to get the same money? So, and if the interest rates are common, because today under the Companies Act, you can't take any interest-free loan from a group company, so as to say. So it is important for you to understand that whether the entity is taking loan from a group company or whether the entity is taking loan from a related parties. Now, if you look at the auditor report, I think we have discussed it very clearly. Are there any qualification of emphasis of matter para in the audit report? Sometimes, my friend, unfortunately, sometimes the auditors try to put some information in the audit report, which could be called as a qualification as well. So you should look at that. What is the matter which is the auditor has given emphasis upon it? and whether that matter affects the financial results of the company. And all these qualifications need to be supported by the potential impact on the profit and loss account. So whenever you're looking at it, any profit and loss account of a company, try to look at the profit number which is reported and try to add or less the impact of the qualification. It should be or 99.99% it should reduce the profit only. So whenever you're looking at any profit, any financial statement or any annual report which has a qualification, it's a no to go situation. But even if you want to go and look at that entity, it is very clear that you should adjust the potential impact of the qualification. There is any key audit matter which we just discussed, that if there is any significant areas of management judgment and estimate, because as I said, if there is significant area of judgment or estimate, it could have potential management bias also, which need to be evaluated. Impairment on loss making subsidiary, there are many auditors which will write that the impairment loss on the subsidiary had not been provided for. That is mainly just to, so because maybe because your profit numbers are not supporting in the current year, which you will do in the next year. So whenever you are having any kind of companies which have such kind of matter getting reported in the auditor report, please adjust your profit to that extent, because it is sooner or later this impairment need to be provided in the profit and loss account. Apprehension on a going concern of the company, if because as per the regulatory requirement, the auditor need to comment on a going concern of the company also. Now if the auditor has commented that the company may not be a going concern company in the future, then it's a red flag for us basically to make an investment. Like for example, some of the airlines entities in past have got this kind of an issue where the auditor has raised a red flag long before the company went into winding up or the company went into a liquidation kind of a thing. And inconclusive reporting due to lack of information, this is a serious red flag. If you're reading an annual report where the auditor is writing that he has not been able to conclude some of these observation due to lack of information, this is like a very open kind of a thing. So if you have any annual report which is such nature, please look at them very carefully. So my friend, this is some of the red flag which we thought we should bring it to your attention, which one should look at it in the annual report. They range from your boardroom culture to your financial results to your disclosure in the financial statement and to the auditor's report. So these are some of the basic information or a basic red flags which one can identify from reading the annual report. Now, as I said, my friend, I mean, for me, the cash flow statement has become all the more relevant today as compared to any time in the past. Because as I said, currently many of the listed entities where potentially the people make an investment are reporting under Ind AS. And under Ind AS, you have a very different set of accounting which is done, which is recognizing a fair valuation gain or losses on certain item, wherein there is a notional income which is getting recorded in the P&L account and in the balance sheet as well. So, as an investor, if I have to evaluate a company, I will look at a notional income whenever, on a conservative side, whenever there is a loss. But if there is a notional income which has got recognized in the current year, which has actually not translated into a cash, as an investor, I will discount over it. So that's why cash flow statement becomes a very relevant and important area for us. Now, what are the red flags in the cash flow statement which one should look at it? One is that, as I said, declining net profit, net operating cash flow, but profit as per P&L account. This is simple and basic, that if you have a profit in profit or loss account and there's a negative operating cash flow, I mean, this profit has come either from your investing activity or from your one-time income. That means from business, you are not making the money, or from the business, the company is not making the money. So it is not a good company, so as to say. High account receivable and rising inventory level. As I said, there is an increase in the working capital cycle of the company, which is not good for me because my money or the cash which should be in circulation is held up or is stuck with the either my customers or in the inventory levels. That means there is no offtake in the market for my inventory. High capital expenditure with low free cash flow. If I don't have a free cash flow and I'm making high capital expenditure which is not contributing to my which is not supporting, which will not support my revenue growth, so as to say, then this is a red flag for me which I should identify. Like for example, I don't have a free cash flow, but I'm making an investment into mutual fund. I don't have a free cash flow, but I'm making an investment into GSEC. I don't have a free cash flow, but I'm investing into other entity, which is not my subsidiary, which is not like it's gonna supply me raw material, etc. But I'm just making an investment for a capital appreciation, which is not a good investment strategy to look at it. Then large non-operating or one-time cash flow supporting profitability. So whenever you look at the cash flow, whether the profit has come, if you have a negative cash flow, there could be situation that the profit has come on disposal of certain subsidiary or on disposal of certain asset in the of particular entity. So if you have such items in the profit and loss account, you should always remove them from your evaluation. Now, coming to a very important point or important area, my friend, that you will ask me, Pankaj, okay, if we have to do all these things, it will take time, right? I mean, sitting in one day, you will not be able to analyze a financial statement. It takes a lot of time to make a sense of all the financial statement which get disclosed. So there are certain key financial ratios, my friend, which one should look at it whenever you are analyzing any industry. I have just given example of four sector. One is a residual sector. Like for example, in manufacturing sector, what I will look at it, I will simply look at the working capital cycle of that company in terms of inventory turnover ratio, in terms of the debtor or creditor days which are outstanding, in terms of the operating profit, and the current ratio and the quick ratio. Sometimes current ratio also becomes an issue. That's why I will look at the quick ratios. Service sector, what I should look at it? I should look at the revenue per customer, how much I'm making. I should look at the customer retention ratios. That means the customer has been with me for how long, whether the average vintage of the customer is 1 year, 2 year, or it is 10 years and 20 years, so as to say. Why it will is important? Because it will give you, it supports the future projection of the management. If my vintage of the customer is 1 or 2 years, you can't expect 20% growth on year basis. But if your vintage of the customer is 10 and 20 years, obviously the customer has supported you over a growth of 10 to 20 years. So you can expect a growth in the next financial year as well. Employee turnover ratio. The service sector is primarily dependent on the employee. So what is an employee turnover ratio into your entity? Whether you like it or you don't like it, service sector is completely driven by the employees of that particular organization. If you have a high employee turnover ratio, your services to your customer will be disrupted more frequently as compared to an entity which has a stable employee turnover ratio. So it is very important whenever you are evaluating this service sector industry, how much cost you are incurring on a customer acquisition. This is also an important, because if I have a higher customer acquisition cost and my customer vintage is only 1 year or 2 year, then actually I'm not making any profit, because I'm acquiring a customer and he's going away from my company for within 1 or 2 years, as compared to an industry which has a lower customer acquisition cost with a higher customer vintage. So you need to look at it. What is your customer acquisition cost, my friend, in a service sector industry? I mean, if you look at the banking sector, it is very clearly driven by all financial parameter. Net interest margin, which is nothing but what is my net interest income margin, how much I have earned from my what you say borrower, and how much I have paid to my depositor or lender. The net is nothing but the NIM, which is one of the primary indicator of any banking company. Credit to deposit ratio. How much of the money which I have originated from my depositor have been deployed or for the loans which I've given by the banks. So if I've taken 100 rupees deposit from a particular depositor, if I have given 80 rupees to the, what you say, to the borrower, then I have a very stable credit to deposit ratio. CRAR, which is nothing but a capital adequacy ratio, which shows that how well a bank is capitalized, which is reflected in its CRAR ratio. The GNPA ratio basically indicates that what is the loans which have got defaulted in your banks. So if GNPA ratio is 2%, that means if you have given a loan of 100 rupees, there is 2 rupees which will, there are, 2% of the customer will be in default. Return on equity we just spoke about. Now if you look at the other sector, my friend, Other sector is there is a average revenue per user, revenue per passenger miles, revenue per room, revenue per room. These are all hospitality related ratios, my friend, which is evaluated or depending upon a particular entity or a particular company. So what I'm trying to tell you, my friend, is that whenever you look at it, any particular industry or any particular sector, you should look at it what is the relevant ratios relating to that particular industry or sector, and then you should try to analyze that particular industry. Now, there are some common information which is available in the financial statement, which is in other information as well, which I think we have briefly spoke about, which I will just try to highlight some of them. Like, for example, if you look at, there's a disclosure on corporate responsibility, on the remuneration to the KMP, on the segment-wise performance, loans and guarantees which are given, and investment in relation to the group company. So these are some of the information which are given both in the financial statement and in the other information, which one can look at it to see that whether the entities are disclosing the relevant information both in the financial statement as well as in the other information as well. One important and the last bullet on the presentation I want to specifically highlight, that number of group company as per the group structure and number of entities which are consolidated in the CFS. So let's suppose you have 20 subsidiaries which are there, and you have, out of 20, there are 15 subsidiaries which are getting consolidated in my consolidated financial statement. What is the reason for other five entities which are not getting consolidated? Are they really your subsidiary, or they have been just acquired for a disposal in the near future? That means you could have a gain coming up in the next financial year on the next quarter itself. So that's why it is very important for, as an investor, to evaluate it. What, how many subsidiaries are there in the group, and how many subsidiaries you have, consolidated in your financial statement. Now, if I have to just conclude and give you some kind of a key points for an investor to look at it before I hand over it to my friend to discuss some of the case studies. One is that please compare the financial statement of any entity with the industry trend. You should always have a financial information which is available with you. Compare it with the industry trend. One more important point is that please focus more on the management discussion and analysis. As I said, whether the management has identified the growth aspect and has identified the risk aspect also. Quality of earning. No one-time item should be there in the profit and loss account, my friend. That is what known as the quality of earning. As I said, focus on the cash flows. Cash flows are most important statement in any annual report. Red flags in the Caro report. Whenever you read any annual report, don't read the auditor's report. Don't read the main auditor report. Just glance through it. Go to Caro, you will get more information or more insights into the company. As I said, focus on off balance sheet item, the contingent liability, the litigation which I spoke about. If you have a complex group structure, then you will have a lot of governance issue. So if an entity which you are doing has a very complex group structure, there is a subsidiary, then there is a step down subsidiary, then you have some other structure, then you have a overseas subsidiary. It's a kind of a red flag. Even if, I'm not saying every entity which has a complex group structure will have a issue, but most of the entity which have a complex group structure tend to fail in the future. And then not solely rely on the annual report. And this is my personal suggestion. Don't just rely on the annual report. There is a lot of information which is available in public domain, wherein investor presentation, the earning calls of the of these companies are also very helpful in analyzing the future, because there is a Q&A which happens between an analyst or a CFO or a MD of a company. So in addition to the annual report, please look at these information also which is available in public domain. And this is something related to BRSR, which we have already discussed. As I told you, this is applicable to top 1,000 companies in India. And from 23-24, an audit, some independent expert or some independent practitioner also need to give a report on it. Basically, this is a new practice area which is getting developed, the ESG area. There is a, just to tell you all and just to give you a bird's eye view kind of a thing. There's a whole project which is going on internationally, my friend. There's a IFRS 18 which is coming up internationally, which is applicable from 1st January 2027, where the structure of the PNL will get clarified. So it will become very easy for all of us. Like, for example, look at the illustration which is given in the financial state in the PPT. The income statement, which is now currently income, expense, profit, and then your EPS and all that, will be structured in such a way that you will have a revenue from operating, then you will have a operating expense. That means you can easily make out what is your operating profit. Then you will have your income from investment and interest income, if any, because there will not be any expense, so as to say, to investing activity. Then you will have a financing activity, which is mainly the interest expense on borrowing and lease liability and interest expense on pension liability. So this is the whole project which is going on internationally, which is applicable from 1st January 2027, where your now profit and loss account will appear like this, so to say, which will be very useful and which will benefit everybody from a financial, from a reader perspective. This one-time income which gets included as part of your profit or loss account can be easily identified. Now, coming to a AI tool, I mean, my friend, as you know that there are a lot of people who are now looking at the AI tool as one of the indicator or one of the support service. There's an AI tool which has been launched by the ICI himself, wherein you can easily log in into it. It is available to all the chartered accountant today in India. You just have to put your member login. Once you put your member login, there will be OTP which will get generated. And in the slide, I have just put what you say, the link which is there. And if you look at it, once you go to the main page after you put your OTP, this is the place where you have to go to the industry forum. And once you go to the industry forum, you'll get a CA GPT list. Now, if you look at it, this has been classified or categorized into different industries, so as to say. 5,000 annual report of the company for the financial year 23-24 can be easily analyzed in a click of button. Like, for example, you want to analyze Avenue Supermart, which is a D-Mart, with all other retail industry. You can just go and simply pick up the retail industry section. And like, for example, I'll show you for bank. Like, for example, I go to ICAI Bank Industry AI Analytics, which is fourth from the top. Now, if you look at it, once you click on it, it will appear like this. ICAI Bank Industry Analyst, AI Analyst. Now, I can ask any question on this. I can ask these in the chat GPT. Please compare Axis Bank with all other private sector bank. Please compare Union Bank with all other public sector bank. Please compare Axis Bank with Union Bank. Please compare the profit and loss of the NPA ratio of Axis Bank with the Union Bank, vice versa. It's a fantastic tool, my friend, which is available in the market free of cost by the ICI to help us to analyze the financial statement. Obviously, it is restricted to the, to the to the listed companies as of now. Now, I will hand over this to Meet, who will take you through some of the case studies which are there in brief, that how do you read annual report of a different companies. Over to you.
So as we discussed priorly, that every annual reports needs to be analyzed by viewing the specific industry. So we need to know about the key performance indicators, about the financial indicators and the non-financial indicators of that specific industry. So first, we take an example of Indigo Airlines. So Indigo Airlines is basically an airline industry. So here we would like the airline industry is basically a capital intensive industry where a huge amount of investment is required, whether be it in the aircrafts. Like the aircrafts can be highly invested through purchasing them or even through leasing them, and a high amount of industry is also investment is also required in the infotech. Like the high amount of infrastructure in technology is required for the airline industries, because they need to maintain communications with the towers, as well as they need to operate their websites. And a high amount of investment is also required in the staff, because an airline industry is also a staff driven industry where the quality and the quantity of the staff matters most. Whereas the variable cost in the form of fuel is also one of the important cost parameters for an airline industry. Now, talking about the revenue streams, the primary revenue streams of an airline industry basically come from the ticket sales, the ancillary sales. So the ticket sales are basically the main business, the core business of traveling and taking the passengers to and fro. Whereas the ancillary sales are the other sales and the other services provided by the airline industry, such as you could say they provide the loyalty programs, they give the membership programs, how they earn from them, the in-flight sales made, be it from the food and beverages. And now you can see that the airline industries are also developing to a extent where the food and beverages, for example, when we take off Indigo, is even sold through other platforms. So this is how the airline industries are developing their ancillary sales. Now, talking about the assets could be purchased or leased, as we spoke before this. So the lease also could be of various types. The lease can be like a specific airline industry terminology is something called as a wet lease or a damp lease. When you go to the when you go to the annual report of Indigo Airlines available on the forum, you could see that the damp lease is a kind of lease where the assets is not only the aircraft but even the cabin crew, the pilots, every kind of the staff is also leased out from the other entity. So this is how you could evaluate the airline industry in terms of how much staff is its of own, how much assets they hold, and how much assets they have leased out. So now talking about the operating metrics, so what ultimately you check the industry how they operate, like what are the main factors which which show their operating efficiency. So the first operating metrics which we could see is the percentage of seats filled, which is also called as the load factor in the specific terminologies of the Indigo or the airline industry. Then second one could be a fleet composition, like we said discussed before, that we could check if the fleet composition is purchased or leased. Next, we could talk about the fuel efficiency. I mean, we could say that how the industry is like we can see that the fuel costs are at high at some point. For example, when there are wars between the nations, then how it is reflected in the fuel costs and the fuel efficiency of the airline industry. Is it something very unusual, and is it going with the flow of the industry? We could like ultimately we could check the routes and destinations covered to see the wide range, that how much an airline has its reach among the domestic and the international flights. We could see the available seat miles, which is the capacity to carry the passengers, and the revenue passenger miles, or it could be the revenue passenger kilometers, which shows that how much revenue they are earning from each passenger traveling. Now, when we go to the next slide, we can there are some extracts from the reports of Indigo Airlines, where we could see that the EBITDA margin has been increasing uh, year on year, which could be a positive green flag. Then when we compare the RASK, what I said previously, that is the revenue available per seat kilometers, with the CASK, which is the cost available per seat kilometers. So when we compare the RASK with the CASK, we could see that the revenue they are earning is higher per seat kilometers of per passenger than the cost, which could be another green flag. When we see the revenue streams given below, which is the passenger ticket revenue, the ancillary services, and the other income, we could see that it is an increasing trend, which could be an important point of comparison with other airlines when we compare that how the Indigo Airlines is at its operating efficiency and how it is earning as compared to the industry. And when we see that it has covered a wide range of routes and destinations, and even the fleet overview we could see from the annual report. And in the annual report also mentions how much of their aircrafts are leased and what kind of lease they have taken with what kind of parties. So next, when we go to the like this is basically what we described in the previous slide. So next, when we use the help of ICAI tool, which is the CAGPT, when we compared the table provided to us by ICAI output themselves, is what that the passenger Indigo Airlines is a one airline which is the only profitable airline with a strong operating margin when we compare the low cost carriers such as the Air India group, which is now comprising of Air India, Vistara, and Air Asia, the SpiceJet group, the Akasa Air, which is a new airline comparatively. So it wouldn't be right to compare it with the Indigo and Air India players, which are quite old players. So you could, like, while comparing the annual report, you could also see that you cannot compare a new industry player with a player which is quite an old and experienced player in the industry. So when we see the passenger revenue of Indigo is also great, then the total revenue is great. Then Indigo, which was a loss-making airline till last year, has become a profitable airline from this last FY 23-24, and market share similarly is reflected as 60%. Whereas Go First collapsed due to the financial distress, like when it has high debts, and when we like in previous slides we talk about the financial distress and the red flags such as high debt and the lower revenue. So next we go on to the Bharti Airtel, which is we talk about the telecom industry. So what are the key performance indicators in the telecom industry? So the telecom industry, as we had seen in the key ratio slide, has measured by the ARPU, which is the average revenue per user, which is derived by dividing the total revenue by the total number of users. The churn rate, which is the attrition rate of the customers, like how many customers a company, telecom company is losing in a year, the addition and the ending subscribers that are there for the industry, and the capex, because even the telecom industry, a capex is a capex driven industry where a large amount of towers and infotech and even investing in new technologies and industry trends such as the cloud services, IoT, and fintech integration is required. And even the spectrum auctions of the 5Gs are quite a capex driven industry. So and the revenue model of the telecom service provider is basically how much they charge for their main services, which are maybe the prepaid or the postpaid services, and the other services such as when we say about the fiber services, the direct to home services, which are when you talk about Geo Fiber or Airtel Extreme, which is like a broadband services. So there are many other new developing trends and many various services we could look after in a telecom industry. So when we look after the Bharti Airtel Limited's balance sheet, we could see that it has a significant amount of capex, which is approximately 394,821 million, which could again point out that it is a capex driven industry, and this parameter could be used to compare with the other telecom companies. Next, when we see that it has a good number of customers added during a year, which is 29 million, making it the second most largest industry player after Geo. So here we have taken a second largest industry player because every time we do not look after the big industry. Here we are learning how to compare the industries which are not the leading industries in their entire segment. So the ARPU also, but here when we see the ARPU of Airtel has the industry high ARPU of 209, which is even more than Geo. So now one might think that why is Airtel having a higher ARPU of Geo? So when we go to the next slide, we could see that the Geo has a larger number of customer base. This is because Geo targets a large number of customers, even both in the rural as well as the urban markets. Whereas Airtel is a company which charges higher for its services and has more premium customers. Premium customers as in the private customers, such as private organizations. It has services for its private companies and providing network services and higher services. So that's how the ARPU of Airtel is greater than Geo, whereas the subscriber base and the net profit of Geo is much higher than the when we compare it with Airtel. Then even when we compare the average data usage per user and the average voice usage per user, we could see that Geo has a higher average data usage per user, whereas Airtel has an average voice usage per user higher. So this we could see that how the industry places them in the whole market. So Geo is placed as a industry which is low cost and has good data services, whereas Airtel is some industry where it is placed where it has a strong a prepaid and postpaid services, and a better telecom services. So this is how we could compare the Airtel as well as Jio and a telecom industry. So next, when we
This is also through AI input.
okay, yes. So, this is also through the ICA AI when we had compared the Airtel versus Jio. The entire thing is generated through that. When we had previously spoken about the Kingfisher Airlines and how to spot red flags, as we had discussed that the funds which were initially directed for airlines are now had now been directed to various other businesses, and when we could see that the promoter culture is also not as good. When Vijay Mallya, who was the person like promoter of the Kingfisher Airlines, was not uh, dedicatedly towards the Kingfisher Airlines, but towards luxury. So this is a red flag when the promoter culture, when we could see that the high debt to equity ratio is also there when the Kingfisher Airlines had been like there was a fraud with the Kingfisher Airlines. We could see that the debt to equity ratio of the Kingfisher Airlines in the previous 2 years were approximately 2 or 4, which is a very high debt to equity ratio. And consistent loss has been posted in the profits and loss statement of the Kingfisher Airlines. Then a high amount of uh, owing by the uh, un- Kingfisher Airlines to the suppliers, and the unpaid liabilities was also there, which could be a great red flag. So this is how you spot a red flag using the case study of Kingfisher Airlines. So this is basically a small slide when we speak about the corporate actions. So the corporate actions such as mergers and acquisitions, rights issues, or bonus issues could also be like interpreted through the annual reports of an entity. When we see the potential any corporate actions, like in this case, this is an extract of the Z announcing their merger with Sony in back in 2021 when the discussions were going on regarding the merger of Z and Sony. So this was disclosed and extract from the financials of Z. So this could the annual reports could also be indicative of such corporate actions. Next, when we speak about the goodwill exceptional items, such as when we speak about the Tata Motors goodwill write-off, when they had acquired the Jaguar Land Rover, and in 2019 they had impaired their goodwill, and this goodwill was impaired on account of the reimagine strategy, wherein the initial engines used by the Tata Motors were now reinvented and and Tata from then on was started to focus on more on their EV and the new age technology, and this is why they had impaired their old assets, which resulted in posting a net loss of 7,000 crores approximately, which was majorly on account of the impairment of 15,000 crores approximately. So this again points out the fact that this is a one-off adjustment, and this could not be viewed as that Tata Motors was not operating efficiently at that time, because the other points of operating efficiency of Tata Motors were quite good at that time. So this is how we speak about an one-off adjustment.
Yeah, I think the next one, I will just share the screen. The next one, which we want to discuss is mainly on the on the Axis Bank. So you saw the case study which was put up by Meet on the Tata Motors goodwill write-off. Now, this is another interesting case study which is on Axis Bank goodwill write-off. And people who would be tracking the banking industry would be aware that in 22-23, Axis Bank had acquired a retail consumer business of the Citibank. And what has happened that during that particular year, if you go and compare the Axis Bank profit and loss account, which is presented on the screen, you will find their EPS dropping because the profit EPS had dropped from 42.48 to 31.17 because of this goodwill write-off done on account of acquisition. Now, there is a difference between this goodwill write-off vis-a-vis the goodwill write-off which was done on the Tata Motors. So, if you look at the financial statement of Axis Bank, and this is an extract of the Axis Bank annual report. Now, this whole write-off which was done, the consideration which was paid by the Axis Bank to the Citibank was debited to the profit and loss account of the Axis Bank. Now, part of that was on account of a goodwill. Like, for example, if you look at the extract of the annual report, 12,000 crore was paid by Axis Bank to Citibank as part of the purchase consideration. And this 12,000 crore was purely a purchase consideration paid to the Citibank. Now, out of this 12,000 crore, there were some intangible assets which were acquired as part of this deal. And the remaining was treated as a goodwill which was paid to the Citibank, around 3,000 crore. 8,000 crore was towards the identifiable intangible assets. 3,000 crore was treated as a goodwill in the books of Axis Bank. Now, this whole 12,000 crore was debited to P&L account along with goodwill, along with goodwill. Now, this is not on account of that the brand what was acquired by Axis Bank from the Citibank was not of any use. That is not the reason. It is very clearly spelled out in the annual report of Axis Bank that under section 15, which is, I have underlined it on the presentation, that under section 15 of the BR Act, the bank are restricted from declaring dividend in the event a bank carries any intangible asset on its balance sheet. So whenever you look at any goodwill write-off or any one-off item, it could be because of impairment issue, which what we discuss in case of Tata Motors, or it could be on account of any regulatory provision as well. Now here very clearly the goodwill a purchase consideration towards the goodwill was written off in the year on acquisition because there is a regulatory restriction from declaring a dividend. So that is how, my friend, when you read any annual report, whether it is Indigo, whether it is, Bharti, whether it is, event of Kingfisher, whether any one-off item, like for example, goodwill write-off, you need to pay attention to it that what is the reason for this. The reason is it because it is not operating effectively or there is any regulatory restriction? So, my friend, this is all what we had from our side. What we thought we should tell you that what are the basics of the annual report, how the annual report is constructed, what are the various red flags which one can identify from the annual report, and a tool which is a very fantastic tool which is available to all the chartered accountant, a AI tool given by our institute which one can use in analyzing any or any financial statement or comparing two entities particularly, and some of the case studies on one of the items which are there. So I think we are done, Vipul, from our side. I will just look at the chat. If there are any question, I'll try to address them. I think I should go in Q&A. Okay. So I think one of the question is that while checking compliance under 186 or figures from the latest audited are required to check the applicability of some, can we directly use Ind AS financial statement figures or some adjustment are required as the figures are not at a historical cost? See, section 186, section 188 and all the what you say the conditions which are presented in which are will need to be tested as per the Companies Act need to be tested at their historical cost only and not after making any particular adjustment, so to say, from the financial statement as such. And these 186, 184, 188 conditions are based on the actual transaction value and not on the restated figures. Please also explain reports prepared by infrastructure company. Unfortunately, we didn't took any infrastructure company as part of our example. However, in case of infrastructure company, one need to be very careful which infrastructure projects you are engaged in. Whether are you into a road project, are you into a port, are you into a what you say the now the solar industry, etc. So it depends upon particular industry to industry. Please give example of interpretation of CAM. What I told you, my friend, that whenever you read any key audit matter which is presented in the annual report, please look at it from the perspective whether there is any significant judgment or estimates which have been made by the management on which auditor has relied upon. Now, if there is significant judgment, like for example, if there is a particular case which is going on against the company and it has a substantial, a potential litigation or a substantial quantum involved, if it comes on the company, there could be a going concern issue for a company as such. Now, in those cases, if the auditor has simply relied upon or expert opinion or a lawyer's opinion without doing its own judgment, then that's a red flag for me. Because the auditor or when the auditor is writing, he should also comment upon that whether he is agreeable or he is in favor of the view which has been taken by the legal consultant, and he has done his independent assessment as far as the case is considered, rather than solely relying upon the management for the same. If the company is trading in virtual currency, what we are supposed to check? I think this is an audit question. How often these reports genuinely, most of their companies are good with window dressing and with English language. They play with the words, how a Aam Aadmi should look at these. I think the whole session was designed to address this issue only. Should you, I think the presentation would be shared. How much reliable ICI output? As we have seen, other AI tools are actually giving wrong data in comparison. I will fully agree with you. I was reading at Economic Times yesterday, and there was a whole full article on it, that how I think so. It was a case law which was presented in a court through an AI tool, which was actually not there at all. However, my friend, the AI tool which has been published by the ICI has been validated at across various levels, and it has been tested at various level. So we don't see any, I mean, at least to the extent we have used it, we have not seen any incorrect figures coming in. However, as you know, all machines are subject to corrections and rectifications. Now, there are, how do we check order book from the annual report public domain? I think this is available in public domain. Many a times in the investor call also, some of the MDs and CEO do mention their order book, and this is also reflected in some of the annual reports which are available in public domain. Thank you for all.
There's one more question.
Yes, yes. Is AI tool accessible to non-members? Unfortunately, it is not accessible to non-members. It is only to the members. Yeah, where is the question? In the Q&A only, I'll go.
Yeah, that was the one.
Non-members and members, you're saying, Preeti?
Yeah, that was the
Yeah. So it is unfortunately it is available only to the member, because you have to put your membership number and then you get an OTP, to get the what you say, to go to the link which is there. So thank you so much. If there are no other questions, Preeti, we are done from our side, so to say, and over
Thank
to
you
you,
so
Preeti.
much, Pankaj bhai, for a wonderful session and insightful, eye-opening, I would say. Request Vipul bhai to give a formal vote of thanks. Vipul bhai.
Wonderful session, Pankaj bhai, Meet. Fantastic session. Sir has clearly bifurcated good to read and must read sections in 500 to 600 pages of the annual report. One cannot afford to miss. If you want to do fundamental analysis, definitely must read sections has been clearly identified by this session. AI tools which can help us to intellectually analyze the and quick way analyze the annual report, that has also been shared. Practical examples shared by Meet regarding Indigo, Kingfisher, Airtel, Geo. All our things are eye-opening, and definitely it will serve great purpose to and help us to analyze the reports very quickly. Thank you for the wonderful presentation and sharing your valuable time and knowledge.